Asana continues to be one of these companies that I just have this fascination with. I love the product. The CEO, Dustin Moskovitz, continues to buy stock at just massive amounts. I think at this point, he probably could have bought the entire company at the current market cap if he would have just waited instead of buying when the stock was at much higher levels. So it's kind of an interesting dynamic at Asana. But the company has always lost money and always spent a ton of money on stock-based compensation. Those are really the two critiques against Asana. Over the last couple of years, there's been signs that the company is improving their margin profile, taking costs a little bit more seriously, and it's possible that they're really well positioned in artificial intelligence, not because they're building the next LLMs, not because they have an AI cloud, but because they have an application that can actually use AI in really interesting ways. They have data that customers are putting into Asana. They also have a bunch of plugins that they can use with other cloud providers, other service providers. And they can use artificial intelligence to automate tasks that people do. So this is very different than the way we think about a lot of artificial intelligence with LLMs or with image generation, things like that. So Dustin Moskovitz and the company talked about this a lot on last week's conference call. I'm at least intrigued with what Asana is doing with AI, but I think it's worth looking at the company's recent earnings report, how financials are doing, and what the trends are, because the stock has been beaten up so much that it's very possible that it's at value territory, especially if the company can now get to free cash flow positive and continue growing. This is still a growth company for everything that it's gone through over the past couple of years. As much as the stock is down, the company is still growing the top line. So potentially a lot to like, but I want to kind of give my thoughts on Asana. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's start with the earnings report. This is a look at Asana's first quarter fiscal 2025 earnings report. Highlight a couple of things here. Improvements in free cash flow and operating cash flow year over year. And they expect to be free cash flow positive for the full year. That's a huge milestone for Asana. The reason they wouldn't be net income positive is because of that stock-based compensation. I'll get to that. And revenue from customers spending over $5,000 grew 15% year over year. Asana really started as this tool that you could use as a very small business, but quickly moved its way up to being an enterprise level solution. So that's where the money is for Asana, and that's really where they see the future. And that's why they keep highlighting these numbers. Who's spending over $5,000, who's spending over $100,000. These are things they report each quarter. Operating loss was $66.2 million, or 38% of revenue, compared to $65.2 million, or 43% of revenue. Now, I don't like it when companies report losses as a percentage of revenue, but at least this number is getting better. Net loss, $63.7 million, compared to $61.5 million a year ago. One of the things they talked about is they're actually pulling spending forward because they see a lot of opportunities in artificial intelligence and the tools that they're bringing out. So I thought that was an interesting take. That's at least bullish from management in what they're saying and what they're actually doing. We haven't seen fruit from that yet, and that may be a couple years down the line. The one red flag over the last few quarters is the net retention rate. You would like to see this net retention rate in excess of 110%. This is basically how much is each customer spending. Is it going up or is it going down? So 100% means that they spent the same year as they spent the same this year as they spent last year. And this is on a trailing 12-month basis. So what management said is that this has been falling, but this will turn around in the second quarter. So next quarter is when we'll start to see this bottom and start to get positive. And they saw that in some of their core customers, 102%. And they said that some of these customers that are spending a little bit more are actually well above 100%, 108%. For those spending over $100,000. So that's a pretty positive sign. If companies that are fairly large and are spending over $100,000 have a lot of scrutiny on what they're spending for software right now, are seeing value in Asana's product, I like that trend because we've seen the opposite trend from a lot of other SaaS companies recently. Outlook for next quarter, revenue going to go from $172 million in the first quarter, up a little bit to $177 to $178 million. Year-over-year growth of 9 to 10%. So we've seen that growth rate come down from 100% during the pandemic to now high single digits. Operating loss is going to improve, as will net loss. For the full year, 719 to 724 million is what they expect. Year-over-year growth of 10 to 11%. So it does look like, based on guidance, we're starting to see revenue growth bottom, and maybe we'll pick up a little bit later on this year. And operating losses, just based on what was reported in the first quarter and what's expected for the second quarter, it looks like those losses are going to be much, much smaller, maybe even be profits by the end of the year. So that would be a huge turnaround for Asana. This is why I'm getting intrigued by the stock. This is the one red flag, though, that has always come up with Asana. You can see here revenue, 172.4 million. Look at this stock-based compensation number, $48.6 million. That is an incredible amount of money when you're spending about a quarter of your revenue on stock-based compensation. And that number is actually going up. It's not going down. So that is really the biggest red flag. And it's a little bit crazy given the fact that Dustin Moskovitz actually owns most of the company. He has the most to gain if the stock goes up, and he's giving out stock like candy. So it's a little bit baffling. Their balance sheet is not too bad. They have about $520 million in cash and marketable securities, a relatively small term loan of $42.4 million, and no real debt on the balance sheet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Here's some of their operating trends, and I pulled these on a trailing 12-month basis. You can see that revenue continues to grow over the past few years, compound annual growth rate of 40%. So that's really solid. Net income starting to improve, but you can see that there's a huge gap between net income and free cash flow. That's that stock-based compensation that I talked about earlier. And that's how you get this chart. The number of shares outstanding jumping dramatically over the last few years because of that stock-based compensation. Looks like they're adding about 10% in shares per year. So that's a lot of dilution for the company to overcome. It does mean that the cash burn's not nearly as bad as the losses, but it also means that if the company grows free cash flow, grows revenue, a massive amount of that is going to be diluted by the stock that's just being simply given away to employees. So I would definitely like to see them actually spend that cash instead of giving the employees stock, spend that cash so it's a little bit clearer exactly what is being spent on the business. Now, as far as what's coming in the future for Asana, a lot of talk about artificial intelligence, just like every single company out there. What's interesting for Asana is that Dustin Moskovitz and Asana actually have some major ties to OpenAI and Anthropic. So two of the leading model makers, they're going to be seeing things at least a little bit ahead of time just because of those high-level relationships. That could give them a little bit of a leg up in how applications are using artificial intelligence. Seems like they're finding really nuanced ways to use AI instead of just being a simple chatbot, instead of just being an LLM or an image creator just like everybody else has. They're actually able to implement artificial intelligence in the workflow. So since this is a work management tool, if you can actually take steps out that people don't actually have to do, that can be a phenomenal way to use artificial intelligence. So that's why I'm saying it's intriguing. A subscription, a standard high-level subscription for Asana is only $25 a month. If you're actually adding value, if you're saving somebody even an hour a month, that pays for itself right there in just that hour. So some really interesting growth options for Asana. I'm intrigued by the company, not buying shares yet, but you can see why this has a lot of potential if they can turn around the bottom line and actually improve those margins the way they projected. What do you think about Asana and the future of the company? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.